Warren Buffett, otherwise known as the Oracle of Omaha. He is the most famous figure of long-term value investing. This video is part of our Trading Styles Explained series. You can check out the full series in our YouTube playlist. Long-term investing is a strategy focused not on the short sprint, but on the marathon to building wealth. It shares similarities with position trading, another style that we've discussed earlier in this series that also involves holding assets for a long time. Long-term investing is distinct in its focus and methodology. Unlike position trading, where the objective is to capitalize on significant market trends and movements and may involve more active trade management. Long-term investors select assets based on their potential for growth and resilience over time, with the objective to build wealth. To give you a comprehensive understanding of long-term investing, we'll examine it through these key specific traits. These traits help us grasp the essence of this investment approach. In terms of risk, this approach often belongs to a lower level of risk compared to short-term strategies, as the investor has the advantage of time to ride out market volatility. Even with that said, there are still factors that has to be managed, and these include market risk, such as economic recessions, political upheavals, and even natural disasters can influence market performance and in return, your investment performance. Economic risks, such as inflation or even changes in interest rates, can also impact investment values. Typically, when interest rates rise, prices of bonds tend to fall, and vice versa. The defining characteristics of long-term investing is the extended time horizon, often spanning years, even decades, depending on the investor's goal. Investors in this category are not concerned over short-term market dips, but focus on the potential asset growth in the long run. They could hold their trades from 5 to up to 30 years. Starting an investment journey can vary greatly in terms of the initial amount needed, largely dependent on your individual goals, your chosen platform, and your investment strategy. With modern investment tools and platforms, it is possible to start investing with a relatively small amount of money. One of the common methods is recommended to beginners is the dollar cost averaging. This is a method where you invest a fixed amount of money at regular intervals regardless of the market performance. The key benefit of dollar cost averaging is that it can help you reduce the impact of market volatility on your investment portfolio. Because by investing a fixed amount regularly, you are able to buy more shares when the prices are low and fewer shares when the prices are high, which can lead to a lower average cost per share over time. Imagine you decide to invest $100 every month in a particular stock or mutual fund, and let's assume that the price of the stock or fund units varies each month. On your first month, the price per share is $10 and you invest $100, so you buy 10 shares. When it comes to the second month, the price per share drops to $5. You are still investing $100, but you are able to net 20 shares. When it comes to the third month, the price per share returns to $10. You continuously invest your $100 and you buy your 10 shares. In this quarter, with $100 per month, you are able to buy 40 shares, making your average cost per share $7.50, which is cheaper considering as compared to investing $300 in the first month at $10 per share. This method allows beginners to start small and build their portfolios over time. When it comes to skills, basic financial literacy and the ability to perform fundamental analysis is highly advantageous. Notable mentions such as emotional stability, patience, and discipline to stick to your plan is also essential for the makings of a long-term investor. However, if you don't possess or have limited financial knowledge, you can still do this. Many investors start with limited knowledge and build their skills over time with educational resources or by practicing on simulators or demo accounts. Long-term investing strategy focuses on building wealth gradually and are typically less risky than short-term trading methods. Here are two common strategies that are usually used. The buy and hold strategy. This is one of the most common long-term investment strategies. It involves buying stocks bonds, or other investment assets, and holding them for many years regardless of short-term market fluctuations. The idea is that over time, these markets will gradually trend upwards, and the short-term volatility will eventually be smoothened out. Another strategy is value investing, popularized by Warren Buffett. Value investing involves identifying undervalued stocks that have strong fundamentals but are trading below their intrinsic value. The goal is to invest in these stocks and hold them until the market recognizes their true worth, resulting in a potential profit. The analysis for long-term investing is comprehensive, utilizing a mix of technical analysis, your monthly and yearly charts, fundamental analysis, and macroeconomic considerations. The focus is on gathering a deep understanding of potential long-term value and prospects of investments. In order to focus on broader trends, long-term investors use monthly or yearly charts to perform their technical analysis. But more importantly, investors are primarily looking for companies with strong fundamentals, good earning growth, PE ratios, industry outlooks, and overall positive growth prospect. To select markets and investment vehicles that are suited for wealth accumulation over an extended period, here are some common picks. Stocks. Investing in individual stocks is a classic long-term strategy. Stocks of well-established companies, often referred to as blue-chip stocks, can offer both growth potential and stability. Growth stocks and dividend-paying stocks are also popular choices among long-term portfolios. Bonds. Investing in government or corporate bonds can provide a steady income stream and add stability to an investment portfolio. Long-term bonds, while more sensitive to interest rate changes, can offer higher yields. For our trader spotlight, we have Warren Buffett, otherwise known as the Oracle of Omaha. He is the most famous figure of long-term value investing. His investment philosophy centers around value investing, purchasing undervalued companies with strong fundamentals and holding them for a long time. Revered by many for his quotes, here are some notable quotes from him. That's all for this video. Thank you for watching. You can check out the rest of the series on our YouTube playlist, Trading Styles Explained. If you want to learn more about trading fast and trading smart, check out Mitrade Academy, where we deep dive into the world of trading.